I would love to introduce Debbie Taylor. Debbie is, well, we call her Queen Debbie here at Holistic. So Queen Debbie is the managing partner and chief tax strategist at Carson Wealth. She also has her own very successful firm in New Jersey, and she is an incredibly highly sought after speaker within the industry. So, Debbie, Greg, I'd love to invite you up here. I'll stop sharing and I'll hand it off to you.
Great. Thank you, Laura. Super excited to be here today with this new format, um, which is, some amazing speakers back to back covering all the things that are important to you. And we're happy to kick it off. So it's Greg Schulheis and myself. And I think most of you know Greg. He is the demo master. We call him also the squire. I call him Prince Greg. So a couple things real quick is what's so exciting about Holistiplan, aside from the fact that it has won all these awards and rated the top, tax software, the Bob Veri study, is that within 24 hours of the OBBBA being passed, Holistiplan was live with all the updates. And what that tells you is that for at least a month or two in advance, they were literally working 24 hours a day to try to keep track of everything so that once OBBBA was passed, you were able to go live and start playing around and modeling in the software. So that is really cool. What I will tell you then from being in the software and modeling these scenarios, and we're going to show you some of them today, Greg and I have discovered, and you probably already figured this out, is that there are so many, and I'm going to call them gimmicks, but there's so many limitations, different start dates, stop dates, income phase outs, right? And then all of these things are interacting together. There is no more, drive-by recommendations is what I'm going to call them, right? No more drive-by, no more back of the envelope. That will get you in trouble and that will hurt your client and could cost them thousands of dollars and possibly even lose you a client. And so because this OBBA, if nothing else, has added a layer of complexity onto the tax code that was already complex, but because of how they tried to satisfy the Byrd rule requirements, there are so many phase outs, phase in, start date, end dates, and then how these things work together. This software, Holistiplan, has become more critical than ever in serving your clients, and modeling out when someone has a question has become more important than ever. And so with that then, let's hop in. What are we going to talk about today? What we're going to talk about today is tax planning through 6 phases of life in light of OBBA. So what we did is we took literally just the 6 phases and said, okay, somebody gets married, somebody gets divorced, they become widowed, right? And sort of how the OBBA and the different features and benefits from the OBBA, how they're impacted. And then we do a little bit of a summary because more and more I'm getting asked, right? Now that we've sifted through the rubble and we understand, the key provisions from the OBBA. By the way, it was 900 pages long, over 100 key tax provisions, right? Is, okay, Debbie, what do I need to be doing for my clients, right? Like sort of what's that next level thinking? And so we talk about that. And then we have some case studies, 3 case studies that we go a little bit deeper in, and then Holistiplan age reminders, and then some bonus material at the end. So I'm a big believer, truth in advertising. Here's what we're covering today. So the 6 common phases of life. And of course, not everybody goes through these phases. Like some people never inherit, right? Some people never get married. But what we did is we just tried to take what could be, some typical phases and say what happens when you go from one phase to the other, understanding that no journey is the same. And so the first then possible phase is marriage. And so we wanted to address that. And what we do, as most of you know, is we have a little bit of a mix between, hey, like what the tax laws are, right? Just sort of a little bit of a reminder for many of you, right? So here's some of the tax laws, and then here's how it looks in the software. And so just a reminder that there could be a marriage, penalty or bonus, right? And so with that marriage penalty, remember those top 2 tax brackets, 35 and 37%. They are not double the single tax, the single AGI or taxable income, right? The 35 and the 37%. So there's a little bit of a marriage penalty there all the way up until that point. The married filing joint tax bracket, the dollars are double what it is single. And then those top 2 tax brackets, you see a little bit of a marriage penalty. So that's what we mean by marriage penalty. And then there's actually marriage bonuses as well. And so again, it's something to model out, even if it's somebody coming to you saying, hey, I'm thinking about getting married. What does that look like? Maybe in the old days, you would have pulled out, one of these types of sheets and said, oh, here's what's going to happen. You're going from single, you're going to married filing joint. But now, with all these phase outs hitting in at all these different times, again, even something as simple as going from single to married, I would recommend that you model that out. It's super easy to do. We're going to walk through some of that. The tax credits and deductions, right? And so, the OBBA introduced the expanded SALT deduction, and this could help or harm a couple depending on their income. And so, remember, it's going to be $10,000 basically no matter what. So what's at stake is that extra 30, which gets you to 40, and that $30,000 phases out between 500 to 600, which is a really condensed phase out range. And we're going to model that out. And so this is an area you want to mark this. You want to be super sensitive about this, because if you are not paying attention and you're like, hey, let's do a Roth conversion. Hey, let's accelerate a bonus into this year. And that person was at the $500,000 limit. And by the way, it's 5 to 600,000 whether you're married or single. So talk about, again, a marriage penalty here. And we're going to show that. Then if you're like, oh yeah, accelerate that income, what does it hurt? Oh, we'll do a little Roth conversion. What's the big deal? Well, it could push that client into a 45% marginal rate on that next dollar. And then the home sale exclusion. And so there's obviously here, if you're single, it's 250. If you're married, it's 500. And so let's go and demo some of this out for our listeners. Right, Greg?
Yep. Yeah, well, let me just jump over into my demo environment and we'll take a look at Jennifer and James accumulator. So Jennifer and James are getting married in 2025. In the past, you always have that sort of adage like, oh, great, you're going to be able to benefit from the married filing joint filing status. So I want to just show, what their income situations are filing single. So Jennifer, is an executive at a company. I'll make up the imaginary sommelier in New York City. James is a sommelier, so and I say that specifically because he's got some overtime income. Maybe we could even throw in some income there, just to show you how those two play with the new deduction for tips and overtime. So just going down the line here, as Debbie said, each of them are paying state income tax. They each own a home right now, so they're paying some local property taxes as well. And they're really Jennifer's pushing the maximum of that state and local tax deduction, additional state and local tax deduction. So she's getting the whole $40,000 state and local tax deduction. James isn't getting the whole thing, but he's pushing the envelope here. He's able to itemize at using his state and local tax deduction above and beyond the standard deduction for a single filer. He's also getting an overtime pay deduction of $7,500. And it's really just to show the net result here when we get to our federal and state income tax withhold calculator. So they're looking at about $130,000 between the two of them. So what I've done now is I've created another scenario where we combine both of their incomes.
So this is them being single, right?
Right.
And each
These
of them
first,
single,
correct.
right?
Yep,
Living that high life in New York, and they're paying tax of about $130,000 a year if they're single. Good.
correct. And that's just on the federal side.
Mm-hmm.
So now we combine their income. I'm just going to scroll back up to the top so we can go through this, logically. They have their combined wages up here of 600,000. And as we come down the line, you'll start to see where differences occur. So now they're not able to take this $62,000 of state and local tax deduction. They're capped at $10,000. So now rather than $62,000 of itemized deductions across their two single tax returns, they're getting a $31,500 standard deduction. Again, yeah, go ahead. And because of the increased income, he's over the threshold for the overtime deduction. So he's no longer James is no longer getting this overtime deduction. And you'll see how everything sort of ties out is that what was a roughly $131,000 federal tax bill is now a $141,000 tax bill. So while you might think that the compressed lower brackets for single filers would negatively impact these two, and that filing jointly would be an improvement. What we actually get is a $10,000 increase in tax with no other changes to their income for that year.
Yeah, and it's interesting because without any other changes going from single to married filing joint, I'm going to think a big part of this is the loss of that SALT
It is
opportunity,
definitely.
right? And so maybe, we didn't model this part out, but if SALT was not on the table, maybe the impact would not have been so great. But with
Right.
SALT on the table, it amplifies something. You're going to do it? Yeah.
I'm gonna do
Yeah.
it.
All right. Let's see.
Um, so I'll show you quickly what that would look like. So if they, because the married filing joint example already phases them out of SALT, I don't need to change the tax law for that. But I can show you what this would look like had they not had that expanded SALT deduction. So now they're each capped at that $10,000 SALT deduction. They're
Right.
each taking the standard deduction.
Yeah.
And I would imagine that it's probably a pretty similar end result as
Yep.
far as, yep,
That
it's they actually in this case they would be saving money. They would be saving money by filing jointly.
Yeah.
So
So I mean, this is unbelievable when you really think about this, Greg, because just one provision, this SALT provision, literally changes, literally changes everything in this entire calculation, right?
absolutely,
Yeah, that's fascinating. Yeah, that's great. Good.
absolutely
Okay. And
perfect.
again, a reminder of whatever those old rules are, they don't make sense anymore, right? So, like Greg said, where you would have been like, hey, this is probably, about the same. You pull out your little handy dandy sheet and look at it and say, oh, you're going to be about the same. We're not, you don't really have an issue. But because of some of these more gimmicky provisions and the peculiar limitations with each of these provisions, he lost the overtime deduction, and then they lost 30,000. Well, they went from 40 to 10 on SALT, but then they had 20 between the two of them. So they didn't lose all of the SALT, but they lost enough of this.
About 40,000 of it between the two of them.
Yeah. Yeah. And then losing the overtime. These are two things that you did not have to worry about, a month ago, basically. And that changes the calculation. Great. That's great, Greg.
Perfect. Move along to divorce.
So just as an aside, then as a reminder, then the key thing with the SALT is that 5 to 600, and remember that's per return. Doesn't matter married, filing, joint, or single. But if you have a client that's anywhere near that range, or for that matter, anywhere near any of these phase out ranges, like you've got to proceed with caution. And what I mean then is you should be modeling it out. All right, Greg, back to you.
All right, should be seeing divorce here.
Mhm.
Do you want to go through these, Debbie, or should we jump right into demo?
Yeah, so real quick on divorce, the key thing is that the TCJA limited the ability to deduct alimony payments, and the OBBA continues, along that thinking, so that there's no deduction for alimony, nor do you have to report the alimony as taxable income. And there's a lot of fraud in this area, and I think that's one of the many reasons why they did away with that. And then yeah, and let's do that. Let's then hop into the modeling.
Perfect. So I will come into my model here. And what we have here is a married couple. They're earning $350,000 a year together, and they're getting divorced in 2025. So what I wanted to illustrate is the impact of something like, say, selling the house. Oftentimes when folks are splitting up or separating, maybe the house that they own together, they're going to sell it. They'll each find their own place to live going forward. So it's really just to illustrate the impact of selling that property in the year of the divorce occurring or prior to the divorce being finalized, rather than waiting until one of the individuals themselves sell the house. So we have our income here, and what I'm showing here, as Debbie alluded to earlier, is that married filing joint couples get a $500,000 exclusion for gain from a home sale. So let's say this couple has owned their house for 10 years. It's appreciated about $300,000. So there's going to be a $300,000 gain realized. So on my left here, I have my joint filing scenario where they don't have to realize a gain because if they sell the house while they're filing joint, they can exclude that full $300,000. However, if they were to divorce in 2025, and let's say that one of the spouses gains control of the home and decides to sell it in 2026 after the divorce has been finalized, they no longer have the benefit of that $500,000 home sale exclusion. They're now limited to a $250,000 home sale exclusion. So if we sell at a $300,000 gain, which I'll just show you my notes here. I have a home sale of $300,000. I have my home sale exclusion of $250,000. I have a net gain of $50,000 that my single filer now has to realize on their return. So just to show you how that impacts their 2026 tax return. So maybe in 2026, if they didn't have to sell the house and realize that gain, just going down the line and showing how that impacts their tax situation. Obviously, at a 20% tax rate, they're incurring about $10,000 of additional taxes just because they waited to sell this house.
Yeah, and I just want to be clear on this, is that, there are ownership and use tests in connection with qualifying for that $500,000 exclusion. And so I just want to clarify that because you see it when there's also like a death. And so there's time limitations. So if you've got a client who is divorced or is newly widowed, there are ways that they can still take advantage of the married filing joint if they're meeting the ownership and the use tests. And so I just want to make that clarification. So for
Yeah,
example,
thanks, Debbie.
to
Yeah, go ahead.
maintain the marital exclusion, like if both spouses stay on the title post divorce, then they're possibly able to take that $500,000 exclusion. So, and again, just be careful here. If there is some type of like break in the custody or some change, again, there are ways to qualify for the $500,000 exclusion depending on ownership, use, and the timing. But the point here, notwithstanding that, the point is still the same, is that for whatever reason, if you do not qualify for that $500,000 capital gain exclusion, then this can become very expensive. And so something you want to be sensitive to, again, is the timing around this when there is a change in filing status.
Correct. And just to highlight a couple of additional considerations, we were perhaps there's a procedure that needs to be done, and $25,000 of medical expenses are going to be incurred. This is more just a comparison of filing joint versus filing single. But it could occur in the case of a divorce, deciding when to incur those expenses if there's some optionality. As a joint filer, because of the AGI floor on deducting medical expenses, something like a $25,000 medical bill would provide no benefit filing jointly because of their AGI. But if they were to file single, they could potentially receive a deduction for excess medical deductions over that floor. On the flip side, what could end up happening, given this situation, is that as a joint filer, they are within the income range to receive their full child tax credit for their dependent child. But as a single filer, their income exceeds the phase out for a single filer, and they're no longer able to take advantage of that credit. So to Debbie's point, just all of these deductions credits, just they're all intertwined and have different phase outs. So just keeping an eye on it, making sure you're modeling it because it's no longer back of the envelope type calculations. So with that, I'm done. I've finished up the divorce demo and I'm going to jump back into our deck and onto retirement.
Yeah, I just want to clarify because there were some questions about the home sale. And so to be clear, and I guess and I made a reference to this before, right? Is when the spouses separate, each spouse may claim a $250,000 capital gain exclusion, which adds up to the 500 as if they're married. If they've owned the home for 5 years, either jointly or separately, and used it as the primary residence for 2 years. And so that's why I was saying the ownership test and the use test. So I know there were questions in the chat, and some different like clarifications and iterations, like, oh, what about basis and stuff like that. The point here when we're modeling out is not necessarily to get into like all that nitty gritty, like, oh, we have basis, because that doesn't actually change what we're trying to model, right? If we had, basis when they were single or basis when they're married, okay, so there's still basis, which then decreases the amount of the capital gain, right? So we're not necessarily getting so much into that part of it. Really, what we're trying to demonstrate is that if you go from married filing joint to single, then all the different areas that can be impacted and how to model that out in the software, right? So just sort of trying to issue spot or identify some things to be thinking about. Good. Okay, off to retirement. Oh, time for me to talk. Okay, so yeah, with retirement, I was like, I just talked. Okay, so the retirement income, right? So we're talking about this. There's all these different sources of income, and a lot of your clients get very confused about this. Most of your clients do not realize that there's sort of two different taxation schemes. There's income tax, and then there's the capital gains tax. And a lot of clients, confuse the two. They don't realize that capital gains are preferenced for the most part. And so just something, again, that you want to be sensitive to when modeling this out. And this is one of the reasons that you want, tax diversification. And when I say that, I mean, you want money in a taxable account, possibly some money in your traditional retirement account, and then money in the Roth IRA, because you do have flexibility, because these things are taxed differently, right? Like interest income is taxed differently than the sale of your Apple stock, for example. And so anyway, just a reminder there, and then the RMDs kicking in. And so one of the things we wanted to remind, because a lot of people are forgetting this, is when the age 73 for the RMDs, that birth year is, the birth year for that versus the birth year for age 75. And a lot of your clients are confused. They don't even realize that there's a potential age 75 possible for RMDs starting in 2033. And so that's something that you might maybe not planning for now or planning around now, but as we get closer, something you want to be planning around. What is also really interesting to us is this new standard deduction. I'm going to say bloated standard deduction, because we have a $31,500 standard deduction that is retroactive to the beginning of this year because of OBBBA. Okay, so they couldn't even wait till next year. That is literally starting in 2025. So that's $31,500 for a married filing joint. Then we have $12,000 for the enhanced senior deduction, and that's if they're 65 or over, and that is to make good on the campaign promise of you're not getting taxed on your Social Security. And then you've got the $1,600 over 65 deduction, standard deduction. When you add these all up together, it's $46,000 in standard deductions. That is a huge standard deduction. And again, primarily driven by that $31,500, which is the doubling of the standard deduction from the TCJA, right? So that number's huge. And then throwing on that $12,000 enhanced senior deduction for two people, so that number's huge. And then the $1,600 over 65, which was already there. And so this is a big number. So remember, prior to prior to the TCJA being passed, 65% of taxpayers were taking the standard deduction. And now 90% of taxpayers are taking the standard deduction. What they're thinking is that because of this expanded SALT opportunity, that maybe less people are going to take that standard deduction. I don't think it's going to go back down to 65%, but maybe it goes from 90 to 85 or 80, because more people are going to fit in and be able to take that SALT deduction. And so we'll have to see. They report those numbers. We'll have to see what that looks like. But you're going to have many clients, as long as they don't hit that phase out range, which we're going to model, right? As long as they don't hit that phase out range, which starts at $150,000 and fully phases out when income exceeds $250,000. As long as those clients don't hit that phase out range, they're going to have this huge standard deduction available to them in retirement. Going to the next slide, then we talk about Social Security taxation. This provisional income and the way this is taxed literally has not been adjusted for inflation, I think, in decades. And so you've got many of your clients, 85% of their Social Security is being taxed because there's no inflation adjustment. And then the medical expense deduction, which we already highlighted. And so after retirement comes potentially, somebody passing, and that's the widowed client. And we talk a lot about the widow's penalty. And so in the year of the spouse's death, you file a joint return, right? So no matter when the partner passed, you're filing a joint return. However, even if the partner passed on like December 30th, when January 1st comes, the survivor is filing single. We think this is somewhat of an unfair system because some folks are left widowed, literally in December. They have no time to plan, no time to think about doing Roth conversions or other tax planning, or even to grieve properly. But this is the way the tax code works. It's very calendar year oriented. And so it's something to think about. If you have clients showing up to you and they're newly widowed, there's this notion of don't do anything for a year. I think that is the worst possible advice, particularly if you really understand how the tax code works. The single filer, so what I have seen is often then that marginal tax rate will go up by about 10% when you have somebody who is married filing joint and then they go to single. We're going to model some of this out. And then, of course, you've got to figure out how to handle that IRA. Is it going to be an inherited IRA? Is it going to be a rollover to your own account? Are you going to take advantage of Secure Act 2.0 and step into the deceased shoes as part of the IRA? So it's actually very complex, the IRA planning, and you don't want to run afoul of this. And FB Pathfinders has a great chart on this that I would recommend you use if you do not already have a good system to make a decision in connection with the inherited IRA for the spouse, because there's so many options. Does the spouse need distributions from the IRA? Well, then maybe it should stay as an inherited IRA. Does the spouse not need distributions? Then maybe you roll it over into her or his IRA, right? Did the younger spouse die first? Well, then maybe you want to step into their shoes under Secure Act 2.0. So just a lot that has to be thought about. And again, a lot of these decisions are not reversible. So you want to get that right. So we talked a little bit about Social Security benefits. Obviously, you step into the shoes of the higher earner if you're not the higher earner. This is one of the ways that income could possibly decrease once you're the survivor partner. But what I would tell you is that this is not enough to make a great benefit in the tax bill, right? So if all you're living off of is your Social Security, then yeah, okay, maybe that could make a difference for you. But if Social Security is just one, part of all these other income streams, then yes, losing one Social Security will decrease your income a little bit. But at the end of the day, you're going from married filing joint to filing single. And for the most part, then that's going to increase the tax bill and also increase those IRMA surcharges, which is, really bizarre math there. And again, you don't have to guess this stuff. Maybe there are situations where it's not impactful. That's where the software is so helpful, because literally you can toggle married filing joint going to single, and you can start estimating what that's going to look like. And of course, make the adjustment for Social Security. The temporary enhanced deduction for seniors. So we talked about that. And then of course, life insurance proceeds. You do not pay income tax on the actual proceeds, but you will pay income tax on the interest that is kicked off of those proceeds. And so with that, we're going to hop into the demo software and show some of the effects of being widowed. One of the things to mention here is, and we've done this with folks who are newly widowed, who've been instructed, don't do anything. We've showed them that doing the Roth conversion in the year that your partner passed, right, that could literally save you tens of thousands of dollars, as opposed to waiting to the new calendar year and then doing it then when you're filing single. And so there is a reason to, to get a move on when it comes to some of these recommendations, however uncomfortable that may feel. All right, Greg, to you.
Absolutely. So what I've modeled here is a 2025 year tax year married filing joint example. So this is assuming that a spouse passes in 2025. You still get the benefit of filing jointly for that last year, but then starting in 2026, you're now filing single. So what I'll show here is really just it's an extension of our 2025 return because in many instances income is likely to be similar across the board. So these are two similarly aged. The couple was very similarly aged, so regardless of how you might be beneficial to handle inherited IRAs, whether rolling them into your own IRA or taking them, assuming the shoes of the deceased, regardless. Our IRA distribution, I'm assuming an RMD of $50,000. And here's our Social Security income, where, jointly they were receiving $60,000 benefit. And as our surviving spouse steps into the higher benefit of $40,000, obviously they're losing some cash flow on the Social Security side. So what I just want to illustrate here is that not only is income decreasing, obviously our standard deduction is decreasing, because we're switching from a joint return to a single return. But just even more so is to take a look at some of these additional deductions that came via OBBBA. So they were partially phased out, or I'm sorry, they were not partially phased out at all. They were getting the full $12,000 enhanced senior deduction as a jointly filing couple. But we can see filing single that she's now receiving only a fraction of that full $6,000 deduction. So you can see how just the switch from joint to single filer has reduced income, reduced deductions, and now we'll see what the impacts are on the tax bracket side. As Debbie said, it's generally about a 10% increase in marginal bracket. So while they were in the 12% bracket filing jointly, the surviving spouse is now in the 22% bracket. We can see total tax on the federal side has increased over $4,000. So not only has income decreased, cash flow has decreased, taxes have actually gone up. So net result is about a $24,000 difference in cash in pocket for this individual who is now a widow and filing singly. Now, I want to sort of just illustrate how, what would be the impact. So, all right, she's now bringing in roughly $24,000 less between the reduced Social Security and the additional taxes. So let's assume she needs to take an additional IRA distribution of $10,000 to support lifestyle spending. Let's just take a look at how that impacts her situation. Not only is the enhanced senior deduction further phased out, she's also now subject to IRMA surcharges. And you can see that the software just does this automatically. It's calculating what those premium increases are going to be. So this ends up being, about $90 a month of additional IRMA surcharge. So over the course of the year, it's about $1,000 of additional premium she's paying for Medicare. And just as a side by side, together they were paying about $4,400 in Medicare premiums. As a single filer, she would be paying about $3,300. So just to illustrate, further illustrate that widow's penalty from all sides: reduced income, reduced deductions, and increased Medicare premiums. It's a pretty stark change across the board, and just further illustrates that widow's penalty.
Yeah, and then the IRMA surcharge. So Greg and I talked about this in advance, and then we actually had a question on this. And so, as if the tax issue is not challenging enough for the widow, the way those Medicare IRMA surcharge, those categories, going from married filing joint to single, could increase about $2,000 over the course of, $1,000 over the course of the year, in taking, in additional Medicare surcharges.
Yep. All right. And with that, we'll jump back to our deck as we move on to our inheritance and postmortem.
So the next stage then is inheriting assets from, a loved one, right? And so there's a lot to think about here. The one thing that's sort of new-ish, courtesy of the Secure Act, is that 10-year rule. And that 10-year rule can drive people into higher tax brackets. So we've been talking about that, and now we're starting to see that more and more, as we're seeing more clients who are inheriting IRAs and actually now having to start take those distributions. And we're going to model that. And then, of course, the estate taxes, and Emily's going to talk about that. But OBBBA increased the lifetime exemption to $15 million starting next year. But also remember state inheritance and estate taxes. And there are over 20 states that have some form of inheritance or estate tax. And so, we want to still be alert and engaged in this area. But Emily's going to go through some of that. And then, we wanted to model out. So for your clients that do inherit the IRA, here's how the 10-year rule could impact them. And just think about it. Most of these were not an issue over a month ago. So yes, there's a child tax credit that was $2,000. Now it's $2,200 under the OBBA. So yeah, inheriting the IRA and having to start drawing it down over that 10-year period, yes, that could affect the child tax credit in the past as it would today. But look at these other provisions that are basically brand new, and there's 5 of them. It's the SALT, it's the auto loan interest deduction, it's tips, it's overtime, and then it's the enhanced deduction for seniors, right? And most of these have different phase outs, different income limitations. Obviously tips and overtime pay is similar, but the others are very different. And again, you need to be careful because your client is being forced to draw down this IRA and take RMDs from this inherited IRA if RMDs were already starting to be taken by the deceased. And now they could lose, some of these other benefits that came through on the OBBA. And so we're going to model this out for you. But just to sort of put on the slide so that you can see these different levers that could be affected.
Absolutely. So to Debbie's point, what we've illustrated here is a married filing joint couple. They have $250,000 of income for the year. As I said, they're joint filers. They have 2 minor dependents, and one of the spouses actually has overtime and tip income as well. So now we want to inject a $2 million inherited IRA. So obviously it would be subject to the 10-year rule. They're inheriting it from a parent, so they are a non-eligible designated beneficiary, subject to the 10-year rule. And for the purposes of depleting that IRA, oftentimes what makes the most sense is spreading out distributions evenly over 10 years. But we'll show you just how that thinking is so important to model out what that distribution would look like over the course of 10 years, because obviously we don't want to leave this to be a ticking time bomb where at the end of year 10, we've only been taking required distributions and suddenly we have a $1.5 million distribution to take before the end of year 10. But let's take a look at what a $300,000 distribution looks like in 2025. So obviously our total income is increasing. But as our income increases, we're starting to reach that phase out of the expanded SALT deduction. So what they did have in terms of a $35,000 SALT deduction is now reduced down to $25,000. What they were receiving for tips and overtime deductions are now completely phased out because of the increased income from the IRA distribution. So no longer getting any deduction for tips and overtime. And finally, they're fully phased out of the child tax credit as well. So no $4,400 credit for 2 children, 2 minor children, now getting 0 credit for that. So it's difficult to compare apples to apples. What it would be, because they are taking a large distribution, but it's just like we said, it's sort of moving in both directions. Income is increasing, paying taxes on the distribution, but also losing deductions that were there previously. So between the credit here, which is $4,400, a $37,500 deduction for tips and overtime, and then also that $10,000 loss there. That's $47,000 of loss deduction and $4,400 of loss credit. At a 35% tax rate, that could be something like a $15,000 swing in taxes, assuming they were able to hold on to those other deductions. Anything else you wanted to add to that, Debbie?
Yeah, I'm just looking through the chat a little bit, so and
Okay,
try to answer some of those questions and keep that moving along. Yeah, so I think we covered that there too. Yeah.
absolutely. All right.
Hey,
So we
Greg,
have
we did have one
yeah.
request to zoom in slightly.
Oh, absolutely. Sorry,
Thank you very
everybody.
much.
So I just want to answer one of the two questions that have come up. So the temporary senior deduction, that is federal. It remains to be seen, how the states handle any of this. So yeah, like that's federal. That's it. That's what we know. And then there was somebody else asking, and so we'll hold this to the end. But working on year-end tax planning, how does the office divvy up the work? So let's just hold on to that to the end. And then there is a question here, Greg, about, and you might not remember this because this went back, did the change also wipe out the overtime? And I believe it did, right? Like that's the change we made. I know we were going back,
Right.
right? But we wiped out the overtime, right?
Right. Yeah. The distribution, the IRA distribution from the inherited IRA wiped out both the tip and overtime deduction.
Yeah. And to be clear, because we're getting a number of questions on the states, the OBBA was just passed. So we don't have any visibility into how the states are going to handle this, what they're going to do. You see some states that follow the federal, and then you see other states that do not follow the federal. For example, New Jersey has, very quirky systems with its state taxes. Even capital gains are taxed as ordinary income in the state of New Jersey. There's a different senior credit that New Jersey has phased in over several years. And so I think as the tax code becomes more and more complex on the federal level, you are going to see more and more states having to chart their own course because they also have budget challenges. And many states are required to have balanced budgets, unlike the federal government, which sort of has a lot more latitude, let's just say. And so we're going to have to wait to see on the states. I have not really seen much of anything. But again, this all has happened in the last month. Okay, let's keep going. And there's just, a ton of questions here. Every time I try to answer a few questions. All right, so the adaptable tax planning and the key to maximizing lifetime wealth. And so this is really just more of that blocking and tackling, right? So taking a step back, like, yes, we're covering OBBA, but we wanted to sort of just go back to some of the foundational ideas, right? So tax diversification to create optimal distribution planning, right? We talked about that before. Roth IRAs and Roth conversions to save on lifetime taxes. This is still hugely important. But we've got to tread carefully now, and we've got to do a cost benefit analysis. Does the benefit of driving down the lifetime taxes and however much it's going to be driven down, does that offset the potential cost of losing out on a $30,000 SALT deduction, for example, right? So we just want to be thoughtful about this. We're still very much in favor of Roth conversions. And I would argue that in most instances, it's still going to have a net benefit to the client, but you don't want the client to have surprises, right? And so you do want to still map this out. Optimize asset location, right? Let's make sure the right assets are in the right accounts. That can literally be hundreds of thousands of dollars of tax savings for clients. And again, a lot of this can get modeled out in Holistiplan. Consider tax loss trading and strategic gain harvesting. And so that's still a very real opportunity, particularly as we come into year end. We had a market that was down 20%. A lot of it's bounced back, but a lot of your clients, whenever we take on new accounts here, we look, and I will tell you probably 7 or 8 times out of 10, their former advisor obviously was not doing tax loss trading, and we're able to find opportunities there. Benefit plans and maximize retirement contributions. We had a question in the chat on this. So this could be, again, another great example to help those clients qualify. and so that they don't phase out of these many benefits. And so that's where making sure that we maximize on our IRA contributions, our 401k contributions, and so on. Also then item 6, possible backdoor Roth conversions, non-deductible IRA contributions, health savings accounts. OBBBA did broaden some of the health savings accounts provisions. So if you've got clients that are in the health savings accounts, you should be looking at that. Annuity and life insurance products. I mean, I need to throw it in there because if I don't, people say, oh, what about life insurance, right? So that is an option. And then charitable donations. One of the things we want to be thinking about possibly is moving some of those charitable contributions forward into 2025 because of that 0.5% AGI limitation that OBBBA kicked in for itemizers. And so again, another little quirk there. And then again, let's not forget our estate planning. So again, that's some blocking and tackling. And then going to the key OBBBA provisions. And so what I just went through was, again, like I'm saying, sort of just standard, like we should all be thinking about these things, approaching our entire book like that. And now 7 key OBBBA planning areas, right? And so first of all, helping them to qualify for the new or expanded breaks. And so we covered these. This is just a reminder of these in one area. One of the things we did not mention is that charitable deduction, the $1,000 single, $2,000 married filing joint. And that is below the line. So I apologize for that. That's below the line. $1,000 single, $2,000 married filing joint. That is for folks who are taking the standard deduction. And what happened is a lot of the charitable deductions dried up as a result of TCJA. So this is an opportunity for people taking the standard deduction to make a small charitable contribution and get, an additional deduction for that. Okay. Roth conversion and distribution planning has to be modeled out. And again, the long-term benefits, expanded Section 529 opportunities. So we haven't talked about this yet, but it's interesting. 529 traditionally was for college. They expanded K through 12, so that's leading in, and then they expanded afterwards that postgraduate, vocational, credentialing, testing, CPA testing and prep, CFP testing and prep, all of that. And then K through 12, they doubled from $10,000 to $20,000 per year, and also expanded for homeschool, tuition, SAT prep courses, all kinds of stuff. And so you've got that 529 plan now really covering an entire lifespan practically from, K, kindergarten, all the way to your professional life and beyond. And then we'd be remiss if we didn't mention the Trump account, which is a whole thing unto itself. I just wrote an article on it. You got the $1,000 contribution for somebody who is born this year and for the next couple of years. And so $1,000, you have to opt in. Those accounts are available starting a year from now. And then there could be a number of contributions into those accounts at $5,000 and a number of other dollar amounts from charities, from family, from employers. And so there's a lot of layering here and a lot of possibilities. The Trump accounts may make sense for your wealthier clients who want to get a jump on retirement planning for their children, right? That to me is really where that Trump account can fit in, because you don't even need earned income. And yet it's essentially a custodial IRA is what the tax treatment's like. So there's a fair amount of complexity on the back end, actually on the front end too, but just something to think about. Let's go to the next one. So a lot of business benefits here, and most of them are permanent. Again, very pro-growth in its orientation. Most financial advisors are not getting into this area in too much depth. This is really the province of the bookkeeper and the CPA when there's a business. What I want you to do is be able to issue spot here. And so we want to possibly revisit entity type, right? C Corp, S Corp, partnership. What should the entity be? This is not for you. This is very complicated. It comes down to cash flow needs and all kinds of other things, but you just want to know that this is something that probably should be revisited. Asset acquisitions possibly should be happening because depreciation opportunities have been expanded. the PTET options to address the SALT, cost segregation studies to qualify for the qualified small business stock, capital gain exclusions. That's where the entity choice also comes in. And QBI deductions have been made permanent at 20%. And again, a little bit easier to qualify for them. But a lot of this depends, again, on how the entity is set up, what the cash flow is. Are we accelerating bonuses? Are we pushing them out? Are we acquiring property so that we're trying to depreciate it? This is fairly the province of, again, that bookkeeper CPA, but know the questions to ask and to prompt your client to go back to their CPA, have these conversations. And we don't want to wait until December to do it, right? We don't want to run out and try to buy equipment in December, right? Or, buy a building, whatever we're doing, or even change our entity type, right? Charitable contribution limitations and options. We just talked about that, right? There's a 0.5% AGI floor if you're itemizing, and if you're not itemizing, you could have that $1,000 or $2,000 on top of your standard deduction. We talked about liquidity events. Well, this is from an estate planning standpoint. We've got that $15 million lifetime exemption that is starting next year. They seem pretty committed to keeping those lifetime exemptions broad. They're going to be adjusted for inflation. Let's do our planning, right? Let's not get lazy. If you have clients that are, have wealth within those ranges, their estates are going to continue to grow. Although something's permanent, it can be changed with the new administration. So you still need to do some of that planning. And remember, again, various states also have laws that can tax estates. So let's take advantage of those. Let's do some planning. All right, back to you, Greg, with the case studies.
Yes, and Debbie, if it's all right with you, I'm gonna just illustrate case study number 3, just in the interest of time.
Sure.
But what we want to do is just, take a look at some more other specific case studies. So, this would be a young married couple. They're in their 30s. They have total income of $350,000, net worth of $1.5 million. 2 young children, $400,000 401k. So what are we thinking about for them in terms of planning solutions? Obviously, maximizing the 401k contributions, always considering Roth. If they can maximize their pre-tax 401k contribution and then potentially do backdoor Roth contributions, whether in the 401k or maybe in an IRA, that's a great way to build both buckets, both pre-tax and Roth buckets. So Debbie just referenced the 529 plans or Trump accounts as an alternative, particularly for their young children. Consider both of those options, and then perhaps some rebalancing of the portfolio, maybe capital loss realization, or maybe some strategic gain realization if they're within the 0 or 15% long-term capital gain bracket. But just keeping an eye on the fact that they're at $350,000 of total income. But if there was some large rebalancing going on across the portfolio, just keeping an eye on that SALT deduction, because that can really negatively impact them as their income grows. They're also losing deduction. It's like a double tax of that income. Nope. This is Mr. and Mrs. Champagne. This is a couple approaching retirement. They live in New Jersey. They're thinking of relocating to Florida. They have income of $500,000. Net worth of $5 million, with $3 million of that in IRA tax deferred accounts. They have 3 children. They're relocating, as I said. So just making sure we're evaluating the differences in state tax implications. Well, I think one area that I haven't really considered too much is just the loss of the expanded SALT deduction as a result of perhaps moving to a no income tax state. So using Holistiplan, modeling that out. Roth conversions are certainly going to be something we are looking at for all of our clients. But again, making sure that we're sizing Roth conversions to maximize that expanded SALT deduction, where possible. Asset titling, obviously, just ensuring that after-tax assets perhaps are in the husband's name as he's the older spouse. In the event of any untimely passing, they would receive a step-up in basis. And then investing idle cash, particularly cash earning interest, which in their situation would be a 32% tax on that interest income. So just making sure they're efficiently investing. And what I want to do, Debbie, if it's all right with you, is just jump back into the model environment, because I want to show what it would look like for a business owner who is deciding to utilize a 401k profit sharing plan and also a cash balance plan. So I will open up Mr. and Mrs. Fortune here, and we'll take a look at what that could look like. So we have Mr. and Mrs. Fortune who have $650,000 of Schedule C income. And what I wanted to illustrate here is just how maximizing a 401k plan contribution uh, would impact their tax situation. So in here we have our self-employed plans. This would be a 401k profit sharing max contribution, and this would be a 401k profit sharing plan and cash balance plan contribution. And just going down the line, we'll see how that benefits them. So obviously they get the deduction for the contributions, but you'll notice a couple of other items here as well. They're also receiving uh, the expanded SALT deduction because their AGI is decreasing. So they were capped at $10,000. Now they're getting the full $40,000 SALT deduction. Not only that, because their income was reduced, they also phased into the QBI deduction income range. So they're getting an additional $24,000 tax deduction for QBI. So just making these contributions to their plan is saving them, nearly $180,000 in taxes. And last but not least, I want to just highlight one, really great aspect of Holistiplan, which is the age reminders. So, we have a lot of dates and ages and requirements. So just watching these age milestones, this is all automatically generated by Holistiplan. This is in our household dashboard. It's going to catch age-based reminders, anything that's coming up. So extra workplace catch-up. So that's the expanded $11,000 catch-up contribution, HSA catch-up, QCD eligibility, RMD age approaching. Using these reminders is so helpful in just catching all of those age-based events and strategies that come up for clients. So just keeping an eye on these, use this to your advantage, and just allows you to do so much planning for your clients. And with
All
that,
right. We are coming on to the end of the hour. Hey, Laura, if you don't mind, Laura, I just want to answer one more question. I've been trying to answer as many in the chat, but you guys are all ganging up on me because it's 800 of you and one of me. So real quick, Laura, if you don't mind, I just want to show the bonus thing here, Greg. And there was a question. So this is something that we sent out to our clients within a couple days of the act being passed. You should be communicating with your clients. And so that's just one reminder, but we did have a question. Hi, Debbie, we are working on year-end tax planning. How does your office divvy up the work so you're not inundated with work toward the end of the year? And this is the whole point of everything that we do, is that tax planning is a year-round activity. We have created a service calendar. We are addressing these things throughout the year, so it's not this big pile-on at the end. And so what I would encourage you is to join in. We have 7 more sessions that we're doing. Some of those are for master members who are Holistiplan subscribers. Some are open to all of you. But we talk about the service calendar. And as we head into the fall, we're going to be laying out the things that we're doing, what the process is, how it's split up among the team. But I think the key change in thinking is that this is this is year round, right? We're constantly preparing for this. So there's not this barrage, only in November and December. So stay tuned on that, and we'll walk you through that in future sessions coming up so you're really well prepared. With that, thank you, Laura. Appreciate everybody here. We were over 800 people. It was really nice to see all your questions and all of your engagement. So thank you.
Yeah, huge shout out. Thank you, Debbie. Thank you, Greg. That was an incredibly powerful presentation. Show them some love in the comments. I know Debbie and Greg would love to see that. They worked really hard on this, especially with the case study. So let's drop them some love in the chat, in the comments, and I know they would love to see that. There was also, I saw one comment that said this was the most powerful demonstration of Holistiplan they'd ever seen. So especially with the One Big Beautiful Bill Act and all of those core tax changes, really powerful. So genuinely appreciate you both so much.
Yeah, we're all learning as we go along, modeling this out, and this is where Holistiplan, it takes center stage. It really does. So yeah, thank you, everybody. Thank you.